Good afternoon, everyone, and welcome to today's panel on the very timely topic of the open banking regulation and its impact on fintech. Open banking in the US is at a critical juncture with the much anticipated CFPB rules under the Section 1033 set to be released soon. These regulations aim to give consumers greater control over their financial data and foster innovation by creating more competition in the financial services ecosystem. As we look ahead to the implementation of these rules, two exciting aspects stand out. The potential for enhanced financial inclusion through more personalized services and the opportunity for fintechs, banks, and other stakeholders to collaborate and bring truly innovation products to the market. We will dig into these and more in the next 45 minutes. I'm Arti Srivastava, investor and today we're joined by four esteemed experts who will share their insights on the opportunities and challenges ahead. Audience members, feel free to drop in questions throughout the panel in the chat box, and we will answer them towards the end of 15 minutes of the session. So our first panelist today is Michelle Scarborough, Managing Director and Head of Consumer Regulatory Policy and Strategy at Citi. Michelle oversees and leads the policy, advocacy, and supervisory strategy across Citi with the CFPB. She comes with extensive experience at the CFPB and US House of Representatives, where she focused on collaborative policy changes for consumers and financial institutions. She has a unique vantage point on how large financial institutions, much like Citi, are embracing open banking. Next up, we have John Pitts, Head of Public Policy at Plaid. Plaid is truly one of the pioneers in the US open banking space, helping millions of consumers connect their financial services accounts to everyday apps. John plays a critical role in enabling and advocating for users to be able to share, control, and access their financial data. Before joining Plaid, John served as a Deputy Assistant Director for Intergovernment Affairs at the CFPB. There, John worked with the state attorneys generals to promote cooperation and coordination between the states in enforcing the Dodd-Frank Act. Joining us as well is Aaron Allard, President of Prism Data. Prism Data is a cash flow underwriting company using millions of data sources to paint a more complete picture of a user's credit worthiness. Aaron has spent a lot of time at the intersection of banking and technology with a focus on bank partnerships, risk management, and regulatory compliance. Prior to Prism Data, she was with Bancorp, Green Dot, CEO of Bloom Credit, and other very senior financial services roles. She has deep expertise in how data can be leveraged to improve financial health and inclusion, and she'll offer perspectives on how open banking can promote some of that. Last, but certainly not the least, we have Vikas Raj, co-founder and managing partner at Resilience VC, an early-stage fintech VC firm based here in DC, investing in financial inclusion and embedded finance. Previously, Vikas was managing director at Axion Venture Lab, leading global investment efforts and serving on the boards of notable companies like Self, Confio, and Tienda Pago. He has invested in over 100 startups over the course of his career, with a particular focus on fintech solutions for underserved consumers and small businesses. We'll hear from Vikas about the exciting new opportunities for startups and the investment landscape as the new regulations roll out and what the emerging market world can learn from these. Welcome again, and thank you once again for joining us today. Apologies for some of those technical issues, but hopefully we have sorted some of those out. So let's get right into it. My first question today is to Michelle Scarborough. Michelle, we hear a lot about the open banking regulations, CFPB 1033, Dodd-Frank Act. You know, this was all published last year, previewed last year. This next set of regulations is supposed to come out in the next couple of weeks. Just to level set and lay the groundwork here a little bit, and particularly for our audience, what is the open banking regulation? What are the origins and why now?
So I would be remiss if I didn't start out by saying that 1033 is the section of Dodd-Frank from which all of this sort of originates. And to be, I would say, a little bit overly simplistic at first, I would say that 1033 really has two large primary objectives. And so what I would bucket those as is The first of which requires data providers make covered data available to consumers and authorized third parties, which is like, doesn't sound very sexy, but the gist is we're just trying to open up the lines of communication between the consumers, the third parties, and their financial institutions to ensure there's kind of a seamless transition of data. And then the second bucket I would sort of put it all into is it sets obligations of third parties that access that covered data on behalf of consumers. And so what does that mean? Just kind of includes limitations on the collection of certain data, the use, retention, selling. Obviously, the rulemaking would want consumers to have the control over their data and it not be abused by those third parties. But in terms of, I think, broadening that out a bit, now that we've got it kind of the two primary objectives of the rule, I would say getting at the spirit of the reg, I think the goals are really around the balance of power between the consumer and financial institutions. And I say that to mean more like financial institutions have the data. It's easy for them to cross-sell to a consumer. But with open banking, it gives the consumer more of that power to be able to take their own data and go to wherever they want to go with it to obtain offers from different organizations. So that's kind of, I think, my first point on this, more the spirit of the regulation. And then secondly, I would say, a really important component of it is increasing competition. And that's not just in like the big space, the G-SIBs of the world, if you will, but more enabling new entrants into this space, allowing there to blossom like more options, more competition, really just more choice for the consumer. I will say though, in thinking about 1033, this big question of what is open banking, there's still a lot of open questions, right? Like when something goes wrong, who has liability? When there's a fraudulent sort of use of data, what happens? Who's going to be responsible for that? Who will the standard setting organization be? And maybe we can like sidebar that so that we can really go into what that even means. And then really generally on the standard setting organization, how will we reach consensus, consumers, advocates, industry on those impending standards? Like, what will that look like? And I think, at least from a large entity perspective, there's a lot of unknowns. There are a lot of unknowns here. We're looking at kind of a framework for moving forward on what open banking will look like in the United States. And I think there's just more to come in terms of answering a lot of those questions.
Thank you, Michelle. That was a very succinct answer. I was expecting way more, but thank you for touching the highlights and really capturing it in a couple of lines. I think you mentioned very key aspects, which is the balance of power. Increasing competition is definitely one aspect of the whole genesis for this, frankly. And then there's a very important question of fraud and security. We're talking about sharing so much data, but how are we going to do it in a data safe and a compliant manner? So we've got folks around the table who'll be definitely weighing in. But just to level set us a little bit more, I want to ask a next question to John, kind of going on the same vein. We've also kind of noted how US is playing a little bit of a catch-up, frankly, to other larger markets like the EU and the UK, where, we have more established frameworks, going back to what Michelle was talking about, the standardization setting. A lot of open banking so far in the US has been fairly organic, so as to speak. So the next question here, John, is for you. Plaid, clearly a pioneer in the space. Tell us a little bit about the origin story. What was the opportunity that Plaid saw back in the day? And what allowed that growth to happen in the absence of the regulation, which we will delve into?
Yeah, it's great. And I really want to build on Michelle's framing here because I think it's exactly right. Let me time travel back 11 years ago to when Plaid was founded. Our founders, Zach Perret and William Hockey, actually started building a personal financial management app. And in the course of building this app, they had two critical realizations that led to a third realization. Realization one was, in order for the PFM app to work, we need some way to get the data from all the places where it sits And that data is really inconsistent and really messy. And getting it from lots of different financial institutions is really hard because it requires basically a different way of getting the data from every single FI. The second realization was that their app, which told people to spend less money, was deeply unpopular with consumers because consumers didn't want to be told to spend less money. And so the app was a complete failure. Which leads to the third realization, which is that the problem they had solved in building the app of getting the financial data into the hands of a third party was actually the important innovation, not the app itself. And this is where the sort of competition framing that Michelle laid out is so important, which is by allowing a consumer to share their financial data with a third party and easily open up an account and start getting financial services from someone else, you lower shopping and switching costs and allow, as a result of that, a lot more competition and a lot more innovation. There's some areas that I would point to as pretty clear examples of this. One is the shift away from overdraft fees. I think that has partly been driven by members of Congress yelling at banks for charging overdraft fees. But I think it's been driven even more by the fact that there's now a lot of institutions that don't charge overdraft fees, and they're actually being really successful in signing up customers. One of them, Chime, I think is now like the number 5 account holder FI in the country. Now, they're not a bank, and by dollar amount, they aren't even close to someone like Citi. But in terms of number of accounts, they're really, really big. And it's because consumers can easily open that account, and that's been a big draw. And that leads me to sort of where has success been in the US market? And Arthi, I appreciate that you ding the US for being slightly behind, but slightly behind in having regulation. And I actually think that has been one of the keys to success, is that the US market was largely driven by companies trying to figure out what consumers really wanted and building to that, rather than regulators trying to create a market through a regulatory structure, which was really the EU-UK approach. Was, we want more competition, we want more fintech, so let's build a regulation and hope that the market follows it. Going back to Michelle's point, though, of that got us through the last 11 years. And the difficulty was there was a lot of uncertainty during that figure it out period, right? Including what data should a consumer have access to? What use cases should be permitted? I remember conversations from when I started at Plaid 6 years ago, where a bank would say, we're happy to allow our customers to share data, but we own a personal financial management app, so they can't share it with any competitors. And it's like, I'm not sure you really understand what consumer financial data sharing means. So what's exciting about the rule right now is we've built up, actually in the US, the largest open banking market, but we've had these unresolved questions like liability, what data, what happens if something goes wrong, what consumer protections should be in place. And the rule that's coming in really is going to answer a lot, but not all, and we'll talk a little bit about the not all hopefully later, but it's going to answer a lot of the outstanding questions in the market, really cementing what the industry and market-driven approach has achieved with increased protections and certainty around it.
Thank you, John. And that is that's exactly what I was going to lead on to here with and perfect segue for that. Now that we've gotten a good history of what it looks like, or we've gotten some of the historical reasons of why it's here. We've seen some of the very natural, organic, market-driven innovation that's happened. Now the regulation is coming. Given that there are some things that are unique to the U.S. system. No prescription, as we see, no standardization of APIs, perhaps, the federal versus state oversight. What are some of the unique ways in which this may play out in the US financial system? And both Michelle and John, feel free to chime in, and Erin and Vikas as well. But John, if you want to start.
I'm happy for Erin or someone else to jump in, since I just talked for like 7 minutes.
No, we have enough questions for everybody. So,
I mean, I would jump in and say I think something that's distinct about the US market is just the sheer number of financial institutions that exist here. I mean, when you look at each individual European country, I mean, comparatively, it's like a 1% of what we have in this country, right? And they're dealing with much more like federalized regulatory bodies, whereas like you were saying, RT, there's state, there's federal. How are they going to work together? And in addition to incorporating the standard setting organizations standards, and how we're going to kind of broach those topics with this kind of layered set of regulations. So I think just the sheer volume, sheer number of financial institutions and potential new entrants is something that makes this space very different.
And just building on that, because Michelle represented the FI space, which I completely agree with, let's talk about the data recipient side, right? Like Plaid by itself has 8,500 different data recipients. And I think the common thing that people think about of like, oh, who is an open banking fintech? People would think about like Venmo, Rocket Mortgage, folks like that. John Deere is a customer of Plaid, right? And they use it to do cash flow underwriting for tractor and combine leases, right? $1 million pieces of equipment where you need to ingest data. One of our fastest growing segments is landlords who want to switch their renters over from paying by check to paying by a direct account transfer so that they can go digital, but without having the cost of debit or credit. So the universe of participants in open banking is really, really broad. The 1033 rule, this was my favorite part of it. The data providers who are subject to the rule is any bank or credit union that has a website. And the CFPB actually did the work and found out that there are something like 1,500 credit unions that don't have a website at all. And so they're not subject to the rule. But you really get the sense of like, we are talking the largest banks in the world are subject to this rule. And some of the smallest credit unions that may only have a couple $1 million of deposits. And at the same time, a fintech startup that might be like two 19-year-olds and a dog in a garage from somewhere are going to be part of this rule. And Rocket Mortgage, the largest mortgage originator in the country, is going to be part of this rule. That's a really complex ecosystem to do it. And that's not even bringing into consideration that the other regulators who might regulate some of these entities include the OCC, the Federal Reserve, the FDIC, the NCUA, the CFPB, any state bank regulator, state money transmitters, right? Like that's a lot of complexity to deal with in a single regulatory regime.
Agree. And, what makes it complex and what makes us unique. But, that's also where we're going to see a lot of the innovation come through. So thank you for sharing those perspectives from a financial inclusion perspective, from the big bank perspective, from some of the CFPB regulatory perspective. I want to shift focus a little bit and go to kind of the consumer side of things here. A question I do have with the panel, given we are talking about financial inclusion here and this overall fintech week we're happening, how do we see open banking promoting financial inclusion for unbanked communities? I would love to start with Erin, and please also share about what some of the great work you're doing at Prism to kind of tackle this challenge head on.
Yeah, thanks, Arti. So I think what's interesting is kind of going back to something John said earlier, which is how, I think it was John, maybe it was Michelle, but how this sort of came about in the US differently from in other jurisdictions, right? So given that in the US, it was really sort of organic or driven by companies trying to provide services for consumers. And that's what's really sort of driven this forward, is because it actually is so helpful in doing so, right? So if you think about what sort of Prism spends all of its time thinking about, which is cash flow underwriting, which is how to expand access to fairly priced products and services by helping lenders make better risk decisions on consumers. So what's kind of beautiful about the open banking data angle is it is much broader. And what I mean by that is there are so many more consumers for whom it is available than some existing traditional data sets like legacy credit scoring. It's very, very recent, right? So you can see literally, if you're pulling an API, what's happening in a bank account very, very recently, as opposed to looking at signals that may be a month or two old in a credit report. And oftentimes it's much more accurate and by virtue of all of those things, more fair. And so what we see, to John's point, is a whole bunch of use cases, right? It's everything from tiny, tiny fintechs that are building a more efficient way to do something where they need data to do it, up to the largest financial institutions, or in some cases, providers of some sort of service in the country that have a need, again, to look at this data to either enhance the existing risk scoring or the existing way of looking at a consumer or even a small business. And you're seeing it take place kind of across the spectrum. What we've seen, which is really interesting, just to put a couple of numbers to it, is of the, call it, I think it's like 70-ish million Americans who may not have a credit score, or they may be too sort of thin file to score. That's a big problem. That's a lot of adults who are effectively being sidelined and sort of aren't able to access products and services that, with this data, you see they actually deserve, right? So we've done a substantial amount of work with our lending partners at looking at this deposit account transaction data, this open banking data, and understanding it, categorizing it, structuring it, being very, very careful about how we do that. So we think about privacy a great deal. We think about fairness a great deal. What we've learned is, of those consumers who might be sort of credit invisible, over 40% are actually creditworthy. They actually perform just as well as someone who has a prime credit score. So if you take that and then you think about when open banking is really sort of put into place, and setting aside the 1,500 FIs that don't have a website, everyone is sort of openly sharing data, and they're doing so in a way that is consumer controlled. They're doing so in a way that is fast, right? So there are actually requirements upon how quickly an FI needs to be able to respond and share the data that a consumer owns and is requesting. That's going to enable even more products and services to be built. So I think we are kind of, to use a sports analogy, we are in the very beginning. We're like the first inning, right? And there's so much more to do. And that's why we're really excited, just based on the numbers that we've seen so far, at what's potentially doable in the years to come.
Thanks, Erin. I know you're doing so much great work here, at least in the US, and with obviously ambitions to go overseas, because cash loan underwriting, frankly, can go anywhere. We just need access to that data. Keeping with the theme of going overseas a little bit, because you've invested globally, you've been managing director of Accent Global Lab, doing a lot of emerging markets investing in financial inclusion, and now you're in the US, so you have a unique vantage point. You can see both markets kind of evolve. How have you seen open banking kind of promote financial inclusion in emerging markets where, we may not have a lot of access to data, where a lot of offline transactions are still taking place, where cash is frankly still king, but, things are changing. India has, seen the UPI, and so many payments have suddenly just gone online. So there's a digitization happening, still not there yet, but how do you see with this new regulation, how do you see it impacting these emerging markets?
Well, John sort of referred to, or actually Michelle rather referred to this being kind of in Europe a regulator-driven effort, and in the U.S. it being kind of an innovator-driven effort. And I think what we've seen in other markets, India, Brazil come to mind, is really sort of like a quasi regulatory agency infrastructure effort. You mentioned UPI, which is a unified payments interface that's being used in India. UPI is really sort of the second layer of something that is kind of called India Stack. And I'm sure many people that are listening know all about this, but in my view, it's sort of the best example of government-led financial infrastructure that's been put in place to specifically drive financial inclusion. And the first layer of that was really Aadhaar, which is, or also called UID, which is essentially digital biometric ID system. There's over 1 billion users as of 2016. Nearly every Indian essentially has a unique identifier. On top of that was really UPI, which was payments totally frictionless and free payments between accounts in India. The most recent step in India is something called the account aggregator framework, which happened in 2021, which is kind of like an open finance framework. So it's similar to what we're talking about here. It includes banking data like the open banking 1033, but it also has investments and retirement funds and things like that. So it sort of moves from banking to finance, open bank to open finance in the sort of parlance in the US. And it allows to securely transfer financial data from place to place, essentially with explicit user consent. That has led to this sort of explosion of more use cases. In India, there's, as of the end of June, I just looked up this data, over 2 billion financial accounts enabled to share data using this account aggregator, 80 to 90 million people using it regularly. So that's sort of an exciting evolution of a stack of financial technology infrastructure that you can see very clearly in India is leading to real sort of progress. Given my background, as Arti said, investing in emerging markets and the US, I get a lot of comparisons between what does the sort of financial inclusion situation look like in the US versus a market like India. And I don't see it as a financial inclusion challenge in the US in the same way, but what we're seeing in India is actually moving from inclusion to resilience. And that's the opportunity, I think, in the United States as well. When you think about something like account aggregator framework in India, it's actually allowing Indians now to access more affordable loans when they actually need them. 4% of credit losses in India come from doctored financial documents. 4%. So just fixing some of that using the account aggregator framework is really helping. That's the sort of thing I could see applying here. It's drastically lowering loan application costs. It's doing a lot around income verification, as Aaron was saying, and wealth management. So, your question was, what is happening here that can influence there? I actually think it's going to happen in the other direction. I think India's stack is sort of way ahead in some ways, at least in terms of sort of government-led fintech infrastructure. And we can learn from that as we think about, and I know we'll get to this, sort of 1033 open banking opportunities here. And the next step after that, which I really think is open finance.
Thank you, Vikas. I mean, that was definitely very comprehensive, and agree that some markets have definitely leapfrogged in terms of technology. Some are very sophisticated, but again, the innovation is here. And welcome thoughts from the rest of the panel. Like, do you agree with Vikas's point? Like, is the US going to influence emerging markets? Are we going to see it work the other way? Or are we just going to take the best of both worlds?
Yeah, I at least think this is going to be a best of both worlds thing. And the reason I think that is, as much as I would like in 2024 for us to have a world where financial services basically works interoperably country to country, we are so far away from that reality, right? Like, part of the reason that India open banking and open finance works so well is the government basically mandated everything from a single digital identity and a whole stack of solutions into the market. Those don't feel likely to be adopted wholesale into the US, nor does a US open banking payments model that is largely based on the fact that it still takes ACH 3 days to clear, and that's where most payments go. I don't see that being adopted by Brazil, which has shifted 80% of their consumers over to an instant payment rail with Pix in 5 years. So I think what we're going to do is have a bunch of countries and markets in dialogue with each other, where we're trying to skim the cream off of each other's innovations, rather than something where one market actually starts dominating others and reshaping them in its image.
I agree.
Makes sense. And sorry, Michelle.
I was just looking at the chat, and I saw the most recent question about the sequencing of open banking in the US vis-a-vis data protection legislation. Do we need a comprehensive data protection framework, or is it on the books? And so what immediately came to mind for me was the impending FCRA proposal that the Bureau will be putting out, allegedly sometime this month. We'll see. But I think that there are some obvious overlaps between what's going to happen with 1033 and the way that the Fair Credit Reporting Act will kind of influence or affect data protection. It feels like, isn't it like one of the oldest data protection, privacy rules, regs ever in the country? I feel like that's a thing that I've read somewhere. I don't know. It's old. So the point is the Bureau is working to update it to incorporate some of these newer efforts like around open banking. And so I do think that they have to work together in order to have like a successful, consumer friendly, consumer protection oriented like movement forward. It felt like it fit into this in terms of like what we're doing here, what other countries are doing, and how we can like influence one another.
No, absolutely. And, staying with the topic of influence or collaboration across countries, let's take it back home a little bit and let's talk about collaboration between banks and fintechs. I know this is a topic near and dear to many. So, open banking, we're talking about all the great stuff they can bring to us. There's a lot of excitement. There's a lot of avenues for collaboration, healthy competition, if you will. So let's start and talk about that. Michelle, I mean, you're at a large bank. How do you envision avenues for collaboration between large banks like Citi and fintechs in this open banking era? What are some of maybe the lower hanging fruit or opportunities where we can actually work together?
Well, I think everybody's kind of touched on this a little bit, but to put a finer point on it, I think a lot of this exists already now. It's just kind of incorporating the open banking aspect of everything, data sharing to this equation. But I do think that large banks, small banks, we all have various partnerships with fintechs that exist today. And so really it's more about, and to Erin's earlier point, about having better customer experiences, better outcomes, better business practices, and expanding, right? That's the financial inclusion aspect. The possibility of expanding underwriting to maybe lesser served populations, underbanked, unbanked, the credit invisibles, the thin file, stale file consumers out there. And to her point of 70 million customers, who wouldn't want to get in on that? Like, seriously. And I assume that those consumers also, want to be part of an ecosystem where they're able to do the things that they need to do in society, buy a car, get an apartment, buy a home, whatever the case may be. So anyway, going back to your question, I really think that a lot of this exists now. It's just how can we better utilize it going forward with the introduction of open banking as a reality?
Yeah, and Erin, if you could build off of that, you have been partnering with large financial institutions, big and small. What are some of the things that have enabled that success? And what are things you could wish for if you had a wish list and if the CFPB was listening? What are some things you would like to see that would come up and help even promote some of that fostering of relationship?
Yeah, it's really funny. I think back, I actually spent most of my career in the bank side, right? So I was almost 15 years at Bancorp and Green Dot working with the fintechs. And now it's been far fewer years, but I feel like more action oriented, maybe coming into the building side on the fintech side of the world. I think what's really interesting is, look, if you are a fintech that wants to work with a financial institution, you have got to really understand, like the whole way through, where do the risks lie and how do you contribute to them and how does the FI contribute to them? Because at the end of the day, and I think this is really hard, honestly, until you're in a bank and you're sitting in the room with your prudential regulator trying to explain how a relationship with the fintech works, how the data flows, how the money moves, what due diligence you're collecting, why that's the right thing as opposed to, some other document or policy. It's really hard to understand. But I think the more that there's kind of more clear communication on what are you building, why does it matter, where do the real risks lie, and how do you manage around them, that kind of climbs from the fintech through the FI to the regulators. And that's where it really needs to go, right? Because a lot of times I have a lot of empathy for the financial institutions that spend an inordinate amount of time when they're doing something innovative or new, sort of educating their regulatory partners. And the better job that the FI can do then the better job the regulator can do in understanding what they need to be supervising for and sort of like where the pitfalls might lie. So I don't know, my wish list is probably very long in this area. And I think it's really just about making sure everyone really understands across the whole spectrum how this works and how it doesn't work. Like a consumer is not letting someone, log in to use their bank account, right? It's getting really, really clear very early. This is what it is. This is what it isn't. Here's how it works. And then, call it like common sense risk management, I think is really helpful.
Great. John, any final thoughts before we move to a very relevant question that has actually come up and a topic that we wanted to delve into further around consumer security and fraud? But before that.
And I'll just tip into that question because I saw it also in answering this, because I think that Aaron touched on something really important here as one of the types of collaboration that's going to happen, which is we're shifting from a open banking, small o, small b market where it was just about data access to a 1033 big O, big B open banking market where it's about compliant data access. And that means compliance partnerships have to be built into the entire data access chain. It's a place where Plaid has, ever since we saw the proposed rule, we've invested a ton of resources over the last year in making sure that how a consumer's authorization is captured and shared with the bank, how a consumer is told about their rights, how they can revoke their data sharing, how they reauthorize every year. All of those things are now compliance obligations, and they're not just the third party's obligation. There's obligations for us to coordinate with a bank like Citi as a data partner to make that work correctly. There's also risk management requirements that Citi has where, I'll just give you my personal take. Michelle, you don't have to endorse it. I think the idea that a bank might have to conduct full third-party risk management over the 25,000 potential data recipients, many of whom will be other banks, is kind of an absurd idea, but it's unclear how you would do risk management in an open banking ecosystem. And I think that aggregators are going to be a key component of that. Before we get into the next topic, the only other thing I would say in terms of where banks and fintechs can collaborate, since no one has mentioned it, and because this is an area where the US is distinct and I think quite exciting, is that fintechs have data provider obligations too under this rule. So a lot of the popular digital wallets are subject to data provider requirements here. And a bank can get its customer to start sharing with them something from their Apple Wallet or their Cash App, or to address one of the questions that someone had earlier, a prepaid card, because prepaid cards are subject to Reg E. A lot of unbanked folks will use like a green dot prepaid card effectively as their bank. Imagine if you can start linking that account to a third party, or if you can start sharing your transaction history on that account with Prism so that you can get underwritten for a loan based on your use of a prepaid card. Like that to me is a really exciting way to leverage technology to expand financial access, even to the hardest to reach consumers in this country.
Yeah, maybe I'll just add to that, Arthi, if that's okay, because that really is, I think John, you're hitting right on the opportunity we see with open banking. It's early doors. And clearly, as you have all described, this is in some ways like a regulatory framework being put on top of something that's already happening. And we don't really even know what all the elements of the framework. So we're all doing a little bit of guesswork, but you can just begin to imagine the opportunities for the sorts of customers our firm tries to ultimately serve, which are really LMI Americans that are financially vulnerable. If you really had a holistic view into all of these different places that money is coming in and out of their lives. We're really excited. Aaron already touched on cash flow underwriting. Boy, we are seeing so many startups that are pick your product, complementing FICO scores with different sort of versions of cash flow underwriting that could just be so much more complete and accurate and ultimately able to push banks towards a HELOC or a mortgage or a personal loan if they really knew they have the full picture. Now, obviously, the way that I read the regs, you guys know this much better than me, is that ultimately the user will have to sort of switch things on and off. And there's a risk that not everything is switched on or off. But if the needed data is there, that's an incredible opportunity. We invest a lot in what we call found money startups that are figuring out how an individual can take advantage of down payment assistance or a tax benefit or a government benefit that can really add to savings or net income, but it's just sort of too opaque to get to. You could just imagine how fintechs, if they had a full view, could pretty cheaply understand exactly where the right application or the right deferment could actually generate new money for LMI Americans. So we see incredible opportunities here. The fundamental challenge our companies face in today's world is making the unit economics work when providing financial products to people that everybody else thinks are too risky and too small. And true open banking should really help with that.
That was incredibly interesting, and thank you for the back and forth there. I mean, just staying with you because you're mentioning this full view, which Erin alluded to, Michelle and John, everybody spoke about, really getting a full view of a consumer's picture. That obviously entails getting access to all the data, but getting access to all the data in a safe and compliant manner, which is the really next big question over here. The compliance, how do you balance this open banking and this push for sharing data, but how do we do it balancing with the security, the user consent? How are they still in control of their data? That's the next biggest topic before just keeping my eye on the clock. But that's a big and a very important topic that I would love to get everybody's thoughts on. So maybe I'd love to start with you, Erin. You are dealing with this on a day-to-day basis. How do you balance consumer access to their financial data with this growing concern around privacy and data security?
Yeah, I think a lot of it goes to, as we think about it, like we are very careful about not accepting PII. We want to have as little sensitive data as possible, right? So when we're receiving data, it's sort of an anonymous identifier. And then if you think about your checking account statement and take out your name and address and all those things, and it's just like the date, the dollar amount and the kind of memo field, which sometimes is helpful and sometimes is a little bit hard to discern. So I think, for us, we have been very careful about making sure that we don't collect anything more than we absolutely need, right? And making sure that our partners, and these are our lending partners, sometimes they ask for advice from us on how to build their application flows where they ask for consumers to link their accounts. And the idea there is making it very, very clear, like, what are you doing with this information? For how long? What are you not doing with this information? Why do you need it, or why is it beneficial for the consumer? And so I think, kind of everyone across the spectrum, making sure that consumers really understand exactly what is happening and making sure that they are still in control, because at the end of the day, this is their data, right? And making sure that as these standards are set in a more detailed way than they are today, there's a clear operating framework for those of us who bear a pretty great responsibility, right? As you get access to this data, it's a responsibility, right? And that folks take that seriously and understand where the guardrails, are and how to stay within them. For us, even beyond privacy, there's sort of like a double click, because if you're using this data in the moment of the provisioning of credit, right, it's another whole host of regulations, right? And so thinking about the balance of when you're looking at transactions and deciding what types of signals a lender should use from those transactions, making sure that you are very accurate in knowing what is a grocery store versus a restaurant, just for example, or a different type of transaction is critical, because on top of that initial categorization is where you build your features and your enrichment and in the end risk scores, and that's where the decisions are made. So we spend an inordinate amount of time looking at making sure that our signals are run first through a pretty thick layer of compliance-minded product set, right? So yes, if we used every signal you possibly could gain from deposit account transaction data, our accuracy would probably be even higher. And there are probably some fairness issues there. So kind of balancing that, how do you get as fair as possible, as explainable as possible from a model standpoint, and as accurate is really critical. And we take different approaches with different products. For example, we have a whole host of attributes, and these are things that customized models can leverage of specific signals. But when you're buying a risk score, you want to have it be incredibly explainable. So we only use about between 35 and 40 risk signals in our score. So it's very easy to understand, why did you get this score versus this, and those reason codes that go along with it. And so I think there's sort of the base case of privacy and security. And then depending on what you're using the data for, or what service you're providing to the consumer, there's a whole host of other regulatory considerations to layer on as well.
Got it. Thank you, Erin. John and Michelle, would love for you to also add on to what Erin was talking about, but also address the very good question that has come in the chat about the data breach and the fraud, and the big players versus the large players. Where does the compliance lie? Whose responsibility is it at the end of the day? Welcome your thoughts there.
Michelle, do you want to go first, or do you want to contradict whatever I say on this?
I mean, I would open with, who knows? I mean, I wish we knew. I mean, I'm hopeful that once a standard setting organization is put into place, that there really will be a way that we can reach consensus, all of us, which I think I started out saying. So it's kind of a beautiful full circle moment here, but just being right. We all want to ensure that we're doing right by the consumer, and we all want to make sure that their data is secure and being used for the purposes that they've outlined via their third party. But I do think that there are a lot of tricky steps that kind of have to transpire between now and then to ensure that everything is safe and secure. In terms of how long that may take, I'm looking at this question. It's a great question. I mean, I feel like we don't have a good answer for that at the moment. But if anybody wants to chime in on that, please.
Well, so let me chime in and say, I want to say two things. One, that this is serious, but two, also that there might be more answers than people are assuming right now, right? And let me start with the second one. Because it's always a little bit mystifying to me why there's such an emphasis on, well, we don't know who's going to be liable for a data breach in open banking. Because I will tell you who has my, and I bet everyone else's, full banking information right now. The HR department of every place you've worked and set up direct deposit, right? Because you gave them a voided check that has your name, your address, your account and routing number, core things that would be part of open banking. And I think if Jim's Electronics, someone breaks into the HR department and steals those records, there's not really any perception that the bank might somehow be liable for that data breach because the consumer gave their data to Jim's HR. Similarly, we actually did just have a couple of major data breaches, unfortunately, right? Like a large hotel chain had all their credit card information breached. The issuing banks of those credit cards were not held liable for that data breach. The largest credit reporting agency in this country had a huge data breach, billions of dollars of liability for them. Large banks voluntarily give a lot of information, not even at the consumer's direction. With the consumer having no role whatsoever, banks are sending all of that data to credit bureaus every day, and there's no uncertainty about whether the bank is liable for the credit for a breach at a credit bureau. And it's not because there's a clear regime in place for that. It's just that the party who gets breached is liable for that breach. So that's my first part of I actually think this problem might be more about we are uncertain. And Michelle, I see you making a face, so I'll say also more about we think our prudential regulators are uncertain about how this is going to work, and less about actual real unclear liability issues. With that said, I think this is one where the entire industry is going to need to work together on helping clarify these things, right? Where if there is uncertainty about where liability sits after this final rule comes out, it is not good enough for a third party to say, CFPB is making you give us this data. and the prudential regulators say, if you give this data, you are liable forever for whatever happens to that data, right? This is one where like liability needs to follow the data. There needs to be some pretty clear rules of the road. And if they're not going to be provided in regulation, it's incumbent upon the industry to work together to develop norms and standards for it, and also to develop tools like critical data minimization, not sharing data when you don't have to, right? So for example, tokenizing an account and routing number instead of sending the raw account and routing number, as long as it functions the same way, that reduces the risk, and it doesn't put the consumer as the responsible party who has to understand and know all of this. They're just de-risked by the companies themselves. So I do think there is real work that we're going to need to do after implementation, but I also think that some of this is just realizing that we already kind of know how this works in the real world, and there's nothing that makes it necessarily work different in the open banking world.
Yeah, I totally agree with that, John. And it's, all of the sort of lack of certainty is compounded in my world because I'm investing in the earliest stage companies that are still in some ways figuring out their business model. So when we're thinking about open banking coming and how to deal with open banking, in some ways, I forgive the kind of weak analogy here, but we talk about it like we're installing airbags while we're still designing the car, where we know that the threats are coming. We have a pretty good sense actually of what those threats will be to the car, right? We don't know exactly what the car is going to look like. So we need to start thinking now about exactly the topics you just said. Who's actually holding the data? We think a lot about, actually, not to give them a cheap plug here, but the CFIs, consumer protection standards. And we think about privacy and security and the integrity of client data and transparency. And we kind of put the onus on our companies, and we track this very closely. We'll look at this in DD to make sure that there's complete transparency about what they're asking for, how the data is being used. You can sort of start with that stuff in mind and then continue to tighten and evolve essentially as these rules become more clear.
Great. Lots of back and forth there. Thank you for sharing. There are some great questions that are coming in, and I'm keeping an eye on the clock. We've got 7 minutes left. I'm glad we were able to get through some of the thornier issues of compliance. Totally agree. It's going to take the entire village to get this sorted, and probably a few more years in the making to figure out where the chips and eventually lie. But just kind of wrapping things up a little bit. We've spoken about the regulation. We've gone through the history. We've looked at some of the pros and cons, some of the challenges ahead. Let's talk about opportunities. Vikas, you're looking at daily business models, fintechs, emerging fintechs. What are some of the bright spots? What are you looking at? And there's a question about AI over here. There's no panel that is complete in today's day and age without a mention of AI. So if you could share your thoughts on what you're seeing in the market, where are some of the bright spots from an investment perspective, and where do you think some of the promising startups lie? And then I have a surprise round robin question for everybody at the end. So.
I talked a little bit about some of the sort of opportunities we see in that step from, the current data aggregator model to true open banking. I mean, I think AI is going to be a big driver of the potential value of open banking. I mean, one of the things that we and I think many fintech investors are sort of obsessed with as a holy grail in financial resilience building is some sort of always on financial co-pilot that is it's like a monitoring platform and ensures that your finances are always optimized based on current world conditions and what you need in the future, what your stated goals are for the future, and what the AI can sort of intuit are what you need in the future, so that every dollar is put to its most productive use, whether it's put into an investment account or used to pay down more expensive debt. And one component of that is offering customized advice and nudges that really do require a view of a customer's financial data. There was a question about open finance. I think this is probably bigger than just account and transaction data. This is also understanding balance sheet for individual households. but it can certainly get better with just 1033's passage. And then I think maybe the next step after that, and I've realized I'm skipping past many sort of compliance and KYC, KYB questions here, but the next step, sort of a fascinating next step, is a platform that's actually empowered to take actions on behalf of a user. You move beyond the nudges to actually making the best decision on behalf of a user, and you don't need a PhD in order to just make the best finance decision in the right moment based on your stated goals. That's something we see a lot in right now. We haven't quite made a bet there because there's still these sort of in part compliance questions and data questions, but we see a lot of opportunity there. Trying to keep my answer short here.
Yeah, no, thank you. And, I think that's what we agree at the City Impact Fund. We've been trying to understand, what is the optimal view, going back to some of the themes that were spoken about. Now we have a better picture of a user's view, hopefully, with all the data that we get in. Now that we have the complete jigsaw puzzle together, how do you optimize it? How do you convert your income into generating opportunities, especially for low and middle income folks? What does that mean? How much do you need to allocate to savings, to retirement? Can you bring down your debt? Can that be automated to some extent for you through some innovative models that we're seeing out there? So agree with you on all of that. Great. I know we're almost at time, so I do have a surprise rapid fire round for everybody. How's this going to work? I've just got a bunch of questions, 4 or 5, 2 options. Don't think, go for it. Tell me what you think, what's your intuition, reaction to it. And we'll start with Michelle, Vikas, Erin, and John. How does that sound? Okay, great.
Let's go.
30 seconds. Number 1, API standardization or market flexibility? Michelle.
Market.
Okay, Vikas.
But what are my options here?
API standardization or market flexibility? And
market.
Okay, market. Okay, Erin.
I'm going to go standardization.
Standardization.
Oh, wow, look at that. Okay, split to the middle. Okay, next one. Data privacy or innovation? Tough one, I know.
Innovation.
Vikas.
I don't feel like I should have to make this choice. I'm going to say privacy.
It's a hard one. Erin.
I'm going to go with smart privacy.
John.
Privacy innovations.
There you go.
Both answers is also in a correct option, but okay. Next one. Fintech collaboration or competition?
You're asking the GSIB? We're going to go collaboration.
Okay.
100% collaboration.
Okay. Erin?
Same. Yep, same.
Competition is collaboration.
Oh, there we go. Okay. Pumpkin spice latte or apple cider donuts?
Apple cider donuts, times 1,000.
Okay, there we go. Clear winner.
We're on, Michelle and I are on the exact same page.
Okay.
You're 3 for 3. Down.
Yeah,
everything
4 for 4.
pumpkin.
This is not even a legitimate choice. Apple cider
Yeah.
donut.
Agree.
Takes
Agree.
this one
Pumpkin
along.
spice.
Yeah.
Ew.
Disgusting.
Okay. Last one for the round. BNPL or embedded finance?
Embedded finance.
Okay.
Embedded finance.
Embedded finance.
Embedded finance.
There we go. That was the winner. Well, thank you so much, everybody, for taking the time. Thank you to the audience. We finished right on the clock. Great questions. And hopefully we will see you back all soon. Thank you. Take care.
Thanks,
Thank
everybody.
you.
Bye.
See ya.